I don't want to give the old tried and true, go to school, get a job, get a 401k and a retirement plan and your life set. I think all of those formulas are going to go to hell. So right now is what you and I have for like 30 years have been saying this, but it's going to get worse. I agree with you.
They've got all these overpriced stocks that pay no dividends, and those stocks are crashing right now, and their whole retirement is going up in smoke.
But when you talk about the CPI, the Consumer Price Index, which measures the price of consumer goods, you've said before that, they change that formula all the time, right? So when they say it's 7%, it's actually a lot more than 7%, isn't it?
Yeah, well, 7% is the number that you get when you use their rigged methodology for calculating consumer prices. And they often compare the inflation today to the 1970s to try to make it appear like it's not that bad. Oh yeah, it's 7%, but it's nothing like the 1970s. Well, it's actually worse than the 1970s if you used the same CPI that was used to measure prices in the 1970s. And if you use that identical CPI today, last year was actually worse than any year during the decade of the 1970s. It was about 15%. And the bad news is 2022 is going to be even worse than 2021 because a lot of companies held back on price increases because they thought it was all transitory. Well, now that they realize that's not the case, you have a lot of companies that are rushing to make up for lost ground, and they're announcing major price hikes here in January. They're probably going to do more later in the year. Look at the price of oil. It's already exploding. It's up about 20% in the last few weeks. We're at a new high for the year. We're at $85 a barrel. I think we're headed over 100 this year, maybe closer to 150. I think by next year we'll be above 150 in the price of oil. It's not just oil. It's all sorts of energy, but it's agriculture. It's industrial materials. The government is trying to blame it on a supply shortage. It's not a shortage of supply. It's a surplus of money. It's all the money printing that is creating the problem. Had the Fed done the right thing after COVID and contracted money supply, then we wouldn't see these big price increases. Maybe there would have been a reduction in supply, but there would have been an offsetting reduction in demand. Instead, we reduced supply because everybody was staying at home instead of working, but we increased demand because we gave all the people who were staying at home more money to spend than what they used to earn when they actually went to work. So it was the worst of all policy mistakes. We threw gasoline on the inflation fire, and now we're dealing with the consequences, and it's just getting started. The money that people have is out of proportion to the productivity. People are getting money not because they're helping to produce stuff,
so
but because it's just being printed.
So Kim and I are actively in the market looking for bigger investments, but it's more dangerous simply because the market's about to crash. So when we come back, I don't want to give the old tried and true, go to school, get a job, get a 401k and a retirement plan and your life set. I think all of those formulas are going to go to hell. So right now is what you and I have for like 30 years have been saying this, but it's going to get worse. I agree with you. But I want to explain to people why it's going to get worse. Like Kim and I right now are panicking because there's so much money coming in because they printed too much money, and there's other people with no money coming in, or they got little money coming in. But it's going to make a big difference what a person does in the future. So what I'm saying is Kim and I are more cautious today than when we're highly pessimistic. So what does a person do? I mean, I really hate the stock market, Peter. I hate it. It's manipulated as hell. I've taken 3 companies public. I'll never do that again. So Kim, so I'm not saying you guys shouldn't do it, but I'm saying don't think there's a panacea. The moon will rise over the horizon on this one.
Right, but when most people, when you think about a stock market, you're thinking about the entire market, an index. I'm looking at businesses. Like, let's say your company, the Rich Dad Company, if you went public and it was at a good valuation and a good dividend, maybe I would want to own part of the Rich Dad Company. I could buy shares in your business. I want to own businesses. I have to get out of cash. but I can't own, the momentum stocks. I can't own these, high-flying companies that don't have any earnings. I want to own something real, so I own businesses, tangible companies that have property, plant, equipment, and I also buy real money. I agree with you there. Buying gold, buying silver, buying mining stocks, that's where people are going to go to get out of
Peter,
harm's way when it comes to inflation.
That's old advice. We've been saying this for 30, 40 years now. You and me.
Yeah, we've been right. We've just been early.
No, but we look like Chicken Little running around with our heads cut off. Kim, what have you done?
We're going to look like
up?
rich Chicken Littles because we're going to have all the money.
Kim, what are you doing to prepare for the future that's getting worse?
Well, again, of course, we're doing gold and silver. We're also doing real estate. And real estate, there's going to be changes in real estate with the supply problem and the all of that happening, people not working. But I'm putting a lot of emphasis into our company online. I mean, since this pandemic or plandemic, whatever you want to call it, happened, people were looking for answers. They were looking for education. They were looking for information, just like you offer, Peter. And so we put a lot of emphasis on delivering information throughout the world digitally. That's paid off in spades for us. So that's where a lot of our emphasis, and to your point, we're also with our investing in other businesses of who we know the owners who are very, very.
Yeah, can I say one more thing, Peter? What's happening right now is for the real estate investors, we have too much money. It's shocking how much money we have in the tens of millions of dollars floating. We can't find a deal.
Everybody has too much money. That's the problem.
That reminds me too, Robert, of that couple. So we have a precious metals dealer that we work with here in Phoenix. And he was telling the story of this couple. They were retired, and every 1 or 2 weeks, probably every once a month, maybe every 2 weeks, they would come in and they would cash in one ounce of gold. So they had a storage of gold, and they would cash it in whenever they needed it, and that was their retirement fund, and it paid off for them.
It made sense for these old guys like me, okay? And they had a stack of gold, and when whatever happened to them, they would just come in to supplement their income. They would be turning.
Well, people can do that now because and in fact, over time, you'll have to sell less and less gold.
Right.
Maybe now you need an ounce of gold, and maybe in a couple of years, 1/10 of an ounce will buy as much as an ounce does today, because gold's going to go up dramatically relative to the cost of most goods and services. But the problem is, you put your money in the bank, you get no interest.
Correct.
And inflation destroys it. I mean, people want to say gold doesn't pay any interest. Well, 0 is better than -5 or -10, which is what you're getting on your cash.
So, Peter, that would be a strategy for an old guy, old person. They could say, well, maybe I should get out of cash. I mean, cash is still going to be good, but it's going to be declining with inflation.
Yeah, it's certainly not too late to listen to us. In fact, it's better to listen now because you could have stayed in the casino that the Fed created all these years and made a bunch of money in tech stocks or cryptocurrencies, and you could take your chips off the table now, and you could buy a lot more gold and silver than what you could have bought had you bought it 5 or 10 years ago. There's no question about that. But Peter, I think you're really pressing your luck if you stay in that casino.
Yeah, Peter, may I support you right now, because I think it's coming. I already see it. There's so much money floating right now. If there's hyperinflation, my generation, the boomer generation, they're toast if they're fixed income.
The people who get hurt the most are the people who are retired. When you hear the news reports, they always want to focus on wages and whether wages are keeping pace with inflation, which they're clearly not. But at least if you've got wages and they're going up 5% and prices are going up 10%, well, you're only 5% poorer. But if you're retired and you've got a fixed income, and prices go up 10%, you get stuck with the whole 10%. And a lot of these retirees have been forced out on the risk curve. They've got all these overpriced stocks that pay no dividends, and those stocks are crashing right now, and their whole retirement is going up in smoke.
That's why, ladies and gentlemen, the reason why I wanted Peter on this show is please start thinking differently. Exactly as Apple said, think different. Because my generation is running on that old go to school, get a job, 401k, and retire. You invest in equities, which are stocks, and then you shift to bonds. That could be the most stupid, high-risk thing you can do today.